We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I'm here today with Todd Nepola from Current Capital Group, and he is located in the sunny, all of us wish we were there, area of Hollywood, Florida. One of my favorite areas of Florida, that whole area down there. So Todd, how are you today?
I'm great, Casey. Thanks for having me.
Absolutely, man. We're glad you're here. Glad you could take the time to be with us and hopefully drop some nuggets on some capital raising and some investing and some. I did notice in your sheet that I was reviewing that you do have experience and knowledge in everything from crypto to REITs and all of that. Is that correct?
Not crypto, but REITs
Not
and
crypto, but gotcha.
I'm not a
Okay,
big fan
cool.
of crypto markets.
Yeah, I don't think anybody is right now, especially it seems like they've shaved a lot of heads here as of recent. So anyway, well, Todd, tell us about yourself, where you come from, how you got to where you are today, and we'll kind of take it from there.
All right. So when I graduated college, it was the 1990s. So I became a stockbroker because that was what everybody did. And that was the tech bubble building at that point in time, right up to 2000. So that was my first experience with the bubble. And when I was a broker in stocks and I started doing some investment banking deals, I realized that it was great, but you only got paid when you did a deal and you got a commission. So I didn't like that style. So that's what drew me into real estate. And luckily it was 1998. And in 1998, there was for sale signs in front of every commercial property and nobody wanted to touch them. So I found a 13,000 square foot warehouse that a developer built in 92 and went broke, and the bank was selling it in a foreclosure sale. And I gave them a call and nobody else wanted it. So I was the lucky or unlucky one to buy it at that point because everyone told me what a fool I was to buy commercial real estate. But I put every penny I had into the deal. I bought the property. It had 7 tenants, 4 vacancies out of the 7. I went and got tenants, refilled it, painted the building, cleaned it up, made it look nice, signed new leases with the existing tenants. And 6 months later, I refinanced it, took all my money back out of the deal. And I think I had about $5,000 a month in positive cash flow. So from that moment on, I was hooked. And that was in June of 1998, I bought that property. So 24 years, and I still own that deal today.
Wow, you still own it today, and I'm sure it's paid for itself many times over, right?
Many times over. And that's always my philosophy. We don't sell the properties. We like to buy them. We do refinance them. We keep very low, limited amounts of debt. But I'm just not a seller. I'm not trying to be a flipper. I never got caught up in the renovate the house and flip this house kind of a thing. I never did anything like that. We're always long-term cash flow and let them appreciate over the time.
Man, that's great. And so far, I'm sure it's never failed you yet, if I had to bet. So one question and it's so funny because you bring up a couple of points there as far as like everybody talks about what a fool you were for buying commercial real estate. And, it's always like that public sentiment becomes what somebody else is scared to do. They call you a fool for doing. And it's it can be mind-boggling at times because, again, it's the same thing when everybody was buying real estate after the 07-08 crash. Everybody that bought real estate from like the end of 08 through, say, 2011, there was a certain what do they call that? Like the people in standing off to the side, the peanut gallery. There was like, man, y'all are crazy. Why are you buying that? What's and it's and those people can never ever see the cash flow. I don't care if the market is down, if the market is up, if the market is sideways. There's always a cash flow component to some degree. Much like the way I say real estate will always sell. Real estate will always sell. The issue is the price.
That's right.
Right? Same thing for finding tenants. real estate will mostly always rent, right? You can always go to a low grade tenant, somebody that's wanting to put in a yarn store or something, a hyper local yarn store, and get something out of it, no matter what.
That's right.
And it's always just really boggled my mind how a lot of people stand around and they're the people that are working their 40 hours and they go home and they do whatever they do and then they get up and work their 40 hours again next week. And it's mind-boggling to me how people can't see that what happens there. So let's kind of move out of that part right there where you got started, everything got kick started and got going. And I'd like to move into a little bit about where the business went to and how it evolved from there.
All right. So from that point, we ran right into 2000, which became the tech bubble. And
Yep.
everybody was a genius in tech stocks and everybody made money. It was the same thing like it was in, everywhere in the world for the last, 20 months or so. And
Yep.
everybody was smart. Everybody had money until they didn't. And it's exactly like you said. Once real estate came out of being the flavor of the day, same thing in '08 and '09, nobody wanted to buy it. And frankly, that's what's probably going to happen now too. And everyone's going to say, well, now all these houses went up in price. Nobody will want to buy them, even if they come down. But the people who have resiliency and keep buying at these prices will ultimately make money. The
Yep.
problem is it gets a lot more challenging because now the banks aren't as aggressive. Investors aren't as aggressive to lend money and put money into limited partnership deals. So you got to work a lot harder. But
Yep.
if we went back, when I went back and sat down and people we know who bought deals and said, like you said, in 2009, 10, 11, 12, if they still hold them, I could all but guarantee they're probably doubled or tripled their money at this point in time.
Yep.
But nobody wanted to buy it.
That's right.
Everybody wants to buy when everybody's buying. And I think it was Warren Buffett said, when everybody's greedy, be scared. And everybody's scared, be greedy. And that always happens in real estate. And it's probably going to happen again, which is okay for me because I'll keep buying.
That's right. And keep holding and keep cash flowing and keep building and keep growing. And that's the difference in longevity. And that's why I think so many of these guys, and correct me if I'm wrong, their business models all say buy for cash flow, period. Don't buy for anything else. The appreciation is great. Appreciation is good for refinancing and borrowing and selling and whatever, but buy for cash flow today. Is that right?
It's 100%. It's what I preach here all the time. We actually have a group of interns here, some high school and college kids, and I was just discussing that yesterday. And I said, I don't really care what the value of my property is per se, unless I'm going to refinance it, because if the property is worth $50 or $40, it really doesn't matter if I'm not selling. I'm only concerned with my income from my rents. And I said, and the danger is when you see, I have a lot of friends who are in real estate, the mindset of the people when they own a house even, and all of a sudden they own a house that they bought, say, for $500,000, and the market takes off, and now the house is $750,000. Well, they're pulling out credit lines, they're going to better restaurants, they're buying jet skis, they're buying mobile homes, but they didn't really make any money. The house went up in price. They've just adjusted their lifestyle. So you don't want to get caught up in the valuations, like you said. You just want to watch what is my cash flow, how much is coming in, and what's spendable. And you're 100% right. If the market does come down, which it may come down, who knows really, but if it comes down, maybe my $100 in rents goes to $90 or even $85 or even $80, but I can still cover my debt service, all my bills, and make money. Maybe I'll make less, but the property's still paying itself off. And the property's still paying down a loan. And I'm just chugging on. And like I said, my timeline is forever. So I just keep letting the wheel go. Not every month has to be a great month, but you have to have the patience to hang on.
That's right. And then, the other part of that is, and go back to my real estate sales experience, right?
Mm-hmm.
When the bubble popped in 07, 08, I was just getting started into sales, the real estate agent element of the game.
Right.
And go fast forward to 10, 11, 12, and values were down from what they were. People owed more than what they were underwater, quote unquote, if you will, whatever you want to call it. And somehow, some way, every seller that I ever had, most every seller that I had, always found a way out. Always. Whether that was, so you're right, they adjusted their lifestyle up. And unfortunately, now they had to either pull money from a 401k, they had to borrow money from mom and dad, they had to borrow money from grandma and grandpa. They had to do whatever they had to do because they had to sell that house. They didn't have any choice. Now they have to sell that house and they're $20,000 upside down. So I remember the discussion that I would always have, and of course, we're talking single family residential stuff, not commercial, but the discussion that I always had with them going up front, I'm like, okay, you owe this. Now, let's hypothetically say that we got to the closing table and the attorney says, hey, John, Mary, Susan, whatever, you owe $10,000. Do we have an ability to somewhere, somehow, some way come up with that $10,000? And they would always, I say always, they would most of the time say, yeah, I guess granddad will give it to me. He'll give me an early inheritance, or I've got some money in my 401k that I can either borrow against or pull out. And they always seem to find a way to make it work to be able to get out of that trap. Now, there was always the people that couldn't. But what I'm getting at is, and you made a very good point, the adjustment of the lifestyle was something that basically they were just borrowing from the future for. And so let's talk a little bit now. You've acquired what is your company's property count or door count? I know warehouse space can be measured in square footage. What do you all look like today?
Right. So what we did is we also started doing a lot of third-party management. So in order to generate leasing commissions and management fees, which is what keeps the lights on in the office, we manage other people's properties too. We only do retail and warehouse products. So we don't do any multifamily. We don't really do any office. So we're only on that side of it. So in global position, we have over 3 million square feet under management. Now, what I have myself is over 1 million square feet that we own personally, and some we have investors in, some I own personally myself. And it's not really any different. It's the same thing when managing it, but the ability to manage other people's property gives us scale, because now instead of having Dollar General in, say, 3 places, I have 14, 15 Dollar Generals. So I have a better relationship, so I know where these guys want to go. So by doing the third-party businesses allowed us to really multiply our business, quite fast.
And I'll tell you, I'll be the first to say you probably get a few emails now. They've kind of lightened up since the investment world really took off about a year and a half or 2 years ago. The Dollar General specifically, I would get emails from their I don't really even know if it was their own brokerage or something like that, but they were selling off the assets, and it's a brilliant business plan, because they're basically just filtering through. They're buying the land themselves, they're building the building themselves, they're stocking it, then they're selling it with a 10-year, 15-year, 20-year lease under certain terms, and then they're locked in right there. So are you all big into the Dollar Generals? And I guess I'm just saying that
we have lots of tenants like that, whether it's Dollar, we're more the mom and pop. So we have the Dollar Generals, we have the smaller guys, whether it's a chiropractor or a beauty bar or restaurants, things like that. So we deal more with what the neighborhood really needs. So like I said, nothing is Amazon or internet recession proof or anything like that. But it's much more resilient in the sense that if you hurt your back, you can't get a chiropractor online. You got to drive to my center and go see a chiropractor. If you get a cavity, you got to go see a dentist. So we focus mostly on those. Now, that doesn't mean that businesses don't change or get hurt, but ultimately, those are the kind of guys that have to stay in business. And when you have, Dr. Smith, say, who's a dentist and he has one practice in one location, same thing in good times and bad, he has to stay in business. He has to support his family. What we stay away from is the big box stuff. So I don't want to have, like the days of having, everybody wanted a sports authority many years ago, and today everybody wants to have Dick's Sporting Good. Those guys go out of business too easily. It's corporate run. It's nobody personal. It's just shareholders, and they make a decision to close. Then you have a 60,000 square foot hole, and you're losing $200,000 a month in rent. We don't go anywhere near that stuff.
You got to figure out a way to piecemeal that to the market and end up. Yeah, I'm in complete agreement. And then, or like you always have those buyouts, and the buyouts always, and that's just like with banks, buyouts always include consolidation to some degree, and consolidation could kill a model like that just very easily. So, so now, are you focused geographically in any certain areas, or do you pretty well spread?
Yeah, we stay only in the state of Florida. My philosophy was always, I wanted to be able to go see my property if there was a situation or any reason. So I want to be able to drive there and be home at the end of the day. So I keep all my properties within a 4-hour car drive. So I can leave in the morning, see what I got to do, see the property, have lunch, and drive home and be home for dinner. So far as we've gone, there's only about 250 miles to the north. I would go further in the state of Florida. I love Florida. I feel we have an edge in Florida because we've been here forever and we know the state, we know the politics, we know the rules. So I don't really plan on going out of state. I'll never say never, but at this point in time, Florida is our target. From now, we're primarily from, like we said, where we are in Hollywood, Florida, Broward County, up to Melbourne, which is just east of Orlando. So we kind of just cross across the eastern coast of Florida, and then a little bit of stuff over in Fort Myers. So we kind of have like an L. Yeah. But the philosophy is be close to your properties. You don't have to be, I tell people, but we like to.
How do politics play into that? You made that mention, and I know with commercial properties, that's a big like that almost that particular word almost scares as many people out as it probably brings in. Yep. How do those play into what you've got going on?
Well, regardless of what your beliefs are in politicians, the state of Florida is very pro-business. So they do a lot of things, and there's a lot of incentives to get businesses here. Long before COVID, in the counties we work in, this state funds these counties very aggressively for companies to hire new employees, to give them grants to start new businesses. And since we work with a lot of smaller businesses, we find out what's available and then we bring it to the center. So, for example, if one of the cities is offering a program where they'll give tenants, businesses in that area, half of the salary for an employee, we'll go find out all the requirements and then we'll go bring it to all of our tenants. So at one point, we had one warehouse park with about 15 employees that half their salaries was coming from the city. And these people were getting free employees. So as a management company, we try and help out that way. And Florida's always been very pro-growth with development too. So there's a lot of grant money to redevelop your properties, and they've really assisted. So I'm very happy in Florida. I'll stay here.
Yeah, I think there's a lot of people that share that same sentiment with you. It's where else can you go? And I've always been like, why does anybody live anywhere else? Every time I go to the beach, take the family to the beach. Matter of fact, we're coming down there here in a couple of weeks, and every time I'm leaving, I'm like, why are we going back to Kentucky again when there's all this sunshine and used to be the retirement capital of the world, it seemed like as well. I know that there was at one point they were very mobile home park friendly. I guess I say that hesitantly because a lot of people were like mobile home parks, but I think they were very mobile home park friendly. I don't know that they so much are anymore, are they? Or do you know?
No, Miami, what a lot of people remember back in the day is, the 60s and 70s, even into the 80s, was where everybody from the Northeast, they would send their grandparents down here to live and retire. And it was very cheap, and they had the early bird specials. And like you said, there was mobile home parks. They could live in a big trailer and then drive themselves back to the Northeast in the summertime. There was a lot of communities that were cheap. Miami and all of Florida, truthfully, has changed so much that you can't afford to do that anymore. The cost of living in Florida has gotten so expensive that it's cheaper to live almost anywhere. So the retirees, unless they're rich retirees, aren't really coming anymore. The mobile homes have been done away with, truthfully, because of the hurricanes. Yeah. So since Hurricane Andrew, the building codes have changed here. It's so hard to get a mobile home park, other than the mobile ones, of course, like where they actually drive in and out. They're just too risky and too dangerous because when a storm is coming, it could, you'll know 3-4 days out. And you don't know which way it's going to turn sometimes, that these mobile home parks would get devastated. So they're very tough to get them done here now.
Yeah, and I know they're very tough to get done anywhere in the United States. I don't think there's, the last time I checked, I don't think there's really any cities in North America. There's no cities in the United States that allow mobile home parks to they're grandfathered in. That's why they always have said they're almost like a Bitcoin asset in and of themselves because they're a limited supply. So let's talk a little bit more about the commercial side of things. Do you, from the tenants, when you go out and start looking for a new tenant, and you have a spot available, obviously there's different classes of tenants, like chiropractors are going to be marketed to in one certain kind of way. But how do you all market to these tenants to get them to come in and look? Because I know that seems to be a big holdup when you have investors and you're like, hey, we're going to go buy these commercial properties. They know that those timelines can be longer and things can sit vacant longer than they would, say, in the residential world.
Well, first I'm going to answer that with what you said earlier was spot on, and I love to hear it because so few people say what you said, that you could always rent real estate. It's just a question of price. So it comes down to where you buy it. So when we buy a center, we don't build brand new centers. We don't do anything ground up because my time horizon isn't 5, 6, 7 years to get paid. So we'll buy and there may be some vacancy. So we have an in-house leasing team. We try our best to strategize who would be the best fit and we'll market to them. We have thousands of tenants. So if we know we have, say, a beauty salon that used to be a tenant there, we'll send an email blast to all of our beauty bars, all of our nail salons, anything closely related, and let them know we have this turnkey space to come take over. Even if the person took everything out, there's a little bit of goodwill there because it used to be a salon. So sometimes we can get it that way. But the truth is, the best way to rent space is still the old-fashioned way. You put a sign up out front. Because if Mary's looking for a space, she's driving down the street and says, "I'd like to be there," she's going to pick up the phone and call and say, "How much?" And if the price is right, you'll get Mary.
And typically, I guess I'm trying to figure out the best way to, like you said, the idea that something used to be a salon and it's hard to quantify what that's worth to somebody. But where do you find these? Are these past tenants, you said, or are they people that you just have on a list of certain different?
Look, I give you a small example. We have a warehouse park, and we had a tenant there, and he had 2,800 square feet, and the guy had a great business, but he at his expense brought in heavy duty 3-phase power, which is very expensive. To bring it in was about $25,000. So He did it. He brought it in. He's been a tenant for years. We just saw him a couple of days ago, and he's done very well. And he's not only expanding, he bought his own building, and I'm very happy for him because you love to see your tenants do well. You're sorry to see them leave, but once he gave us notice that he wasn't going to renew his lease, we immediately took that site and said, who needs 3-phase power? Because now the square footage is not a 2,800 square foot bay, it's 2,800 with 3-phase. So I may get an extra $200-$300 a month for the fact that he put 3-phase in. So I don't want to just advertise it to anyone. I want to try and get that extra add-on. I'll rent it to anybody, of course, but I want to try and get paid for what he's leaving behind. So you always want to try and capture some value for something someone left behind.
Man, that's great. And that's such a, there again, I always say it, I've said it several times on this show, take care of the little money and the big money will take care of itself.
That's right.
And if you can capitalize on those little gains, the big gains will eventually come as well. So now as far as capital raising and as far as having investors and stuff like that in any of your deals that you say you own, is that something that you all do on the regular, or do you have like quote unquote syndications or anything like that?
It sure is. So we've done a bunch of syndication deals. We still do them. Obviously, it's been a little harder to buy properties, and lately we did just close on 2 centers from one seller about 7-8 weeks ago. So you can still get deals done. So yeah, we do raise capital. We have a minimum though. If the deal for us is under $7 million, I wouldn't do a syndication deal, only because of the cost of us putting the partnership together and where we're at. Having said that, if I was just getting into this and I didn't have the money to do it without a syndication, I would do it on a $500,000 deal. The question is, do you have the deal? You don't have to have the money, you have to have the deal. So I would do it at any level if needed. But at this point, like I said, I've been doing this 25 years. If the deal is $2, $3, $4 million, all my investors know I just buy that myself because I don't really want to deal with partners in such small deals.
Well, and it keeps keeping it all under one roof with one person to answer to, and when that one person is yourself, it's much, much easier. So, well, that's great. Now, do you currently do have investors in some of your deals, and how does do you have a certain segment or a team within your office there that specifically handles or takes care of investor relations and so on and so forth, or is there that many of them?
You don't really need an investor relation team per se, because I know all my investors. One thing about me is I'm very accessible. I give everybody my cell phone number. Everyone has my email, so I answer any call.
Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show.
The people who invest in these kind of deals, whether it's my deals or others, as long as they understand real estate. So I won't take people who don't have, a small investor. I don't want $3,000. We have minimums. But as long as these are business people looking to invest, they understand. So every quarter we give them a distribution on the property, and then once a year they get a profit share. But every quarter they get a letter. One or two investors may contact me in between to ask a question about something, or if they drove by the property to comment on something. But for the most part, every 90 days they get an update on the property, they get a check, and they're good. It's kind of like if a person buys Apple stock. I don't really need to know what's going on at Apple. I kind of understand the concept of what Apple is doing. I'd understand real estate better, of course, but I don't have to check my Apple stock every single day. I understand where it's going, and every couple of months I should pick up my statement and see where it's at. And that's where most investors are. The hand holding with the investors, I always find, is more so in the beginning. You got to be very thorough and clear what the expectations are and not oversell the deal. I'm always very careful with that because, if you tell an investor this is your target and that's a long shot and you miss it by even a tiny bit, even if you did really well, you missed the goal. So don't overpromise. Tell them the truth. Investors nowadays just want the truth. They want full disclosure. And what they love about real estate versus just about any other asset class is that they could see the property. So if you invest in my deal and you're a partner with me in this LLC, you're a shareholder, you get an LLC, you get a tax return, you get everything. You're my partner. You could drive to the property. You could see if there's tenants. It's not a wonder what the heck is going on. You own a part of the property. The burden of it is on my management team to run. So we don't have any difference in how we run our properties, whether I own them, they're in limited partnerships, or if they're third party. The management team runs them all the same way. Like I said, we all work for the tenant, but in the aspect of the investors, there's very little attention paid to the investor after the closing.
And that's what I think you dropped several nuggets there. And I think a lot of people, especially when they're beginning syndicators, they're so, like, I remember when I was started in the real estate sales business, I wanted any listing I could get. It didn't matter if it was $10,000 or if it was $1 million. I wanted all of them I could get. And I feel like that's the same thing, that people are undervaluing their worth or what they're bringing, especially if they have a deal, in order just to get an investor. And that's a dangerous game to play because, and people are like, well, we've got a $50,000 minimum. And people are like, wow, $50,000 minimum. I'm like, it becomes less profitable because the smaller the investment, the more, I don't know the best way to say it, the more headache, or the more, like, somebody brings a $5,000 investment, they want to report every day because that's likely their life savings. Somebody sends you $50K, they're taking a percentage of what they've already got out or deployed and putting it with you, and they're just like, hey, send me a check, let me know what's going on, man. And so it's the same. To the same degree. So
it sure is.
Do you ever go out looking for new investors, or are you pretty well just adapt to who you've dealt with in the past, and do they stay in the deals and so on and so forth?
In every deal I've done, I seem to have brought in new investors along the way because it's word of mouth, or I talk to people. We're fortunate that we have a track record, like I said, of decades. So people see the deals we do. What's really helped our business too is a lot of these deals have gotten into social media, or they gotten advertised by the paper. So people see them and they want to get in. And what they like about my deals is when I do a deal, and every one of the deals we've done is I put a lot of capital. I'm almost in every single deal. I'm almost the largest investor as well. So I have my own money in the deal. And then what I've done in all my deals too is I put my capital ahead of yours. So if you were to invest in my deal, and let's say you were going to put 50,000 and I had even 50,000 in, if God forbid the deal went sideways or down, I'm going to vaporize my 50,000 before you lose 1 cent. And that's not something most people will do, but that's my obligation because I bought the deal, I'm running the deal, and I asked you to invest. I should lose all my money before you lose yours. So investors have a real sense of comfort that they're insulated. And if I'm willing to do that, I must really believe in the deal.
Yeah, and the underwriting to a certain degree speaks for itself, but a lot of that can be fodder too, I guess, for lack of a better term. It could be fill area to make somebody feel comfortable. But when you come down and the grits of the deal says, "Hey, my money's gone," okay, and there's $50,000 left. We've each got 50 in the deal. We don't split it. My money's gone. You're getting your 50 back, and that can be a very simplistic way of explaining to a newer investor of, hey, this is why this deal is so good, because I'm willing to risk all of mine. I guess we're going to risk yours too, but I'm going to risk mine first. So,
That's right.
and now you mentioned there when you advertise in the newspaper. I got to hear a little more about that. Is
Well, I
that
was saying
still
advertise per se, but like down here, there's all these sites, whether it be the Real Deal or CoStar. So when your deal gets in, like say the Real Deal, and it's a great app down here, and it's localized, so people see it and they read, I bought another deal, another shopping center. I'll always get calls from guys, hey, let me know when you have another deal. I want to buy a property like that. You got a great price. So you build up a network. So in between deals, I'm always trying to meet with people or talk to people so I have them lined up. This way, when the next deal comes in, I'll let them come in on the minimum to see how the relationship works, of course, but little by little you build it. And I've had people come in for the minimum and then on the next deal say, I want the maximum because I like the deals, I like the way you work. And the biggest pushback I've ever heard from anybody, and how I actually have one of my biggest investors, is he used to invest with somebody else. And when COVID first hit and everything went sideways, the guy would never return his calls. And he said, I didn't need my money. I wasn't even worried. He's like, what bothered me is that they just went radio silent and wouldn't tell me what's going on. And he goes, and that's a big problem. He said, I'm a big boy. If I'm going to lose my money, I'm going to lose my money. So it turned out, we all know the market took off. So he didn't lose any money, but he pulled every dollar he had out with those guys. And little by little, he said, I'll never invest with them because they wouldn't answer the damn phone when there was a problem. And that's the worst thing.
Questionable. They weren't even tough. They got questionable.
Yep.
And
you
that's
cannot avoid the investors.
That's right. That's right. And and I'll be honest with you, and I know I all the time make references to the real estate sales part of this, but it's the same thing when you have a listing for somebody, and all of a sudden, like maybe the market they start to feel a shift, or they're wanting to just say, hey, and if you just pick up the damn phone and say, hey, listen, yeah, everything's cool. I think we need to stay with, just make them feel like they are important for 30 seconds.
That's right.
And it takes care of 30 days, 60 days, 90 days of worry from themselves. But you're exactly right. And those are the stories that really like either kill companies, the people that left them, or they give they're a catalyst to people like yourself. So, well, listen, we're kind of running out of time here. We have a couple of questions that we ask every guest that comes on the show. There's no right or wrong answer, but I got an idea, and you're going to have a good answer or some good answers. Okay. The first question is, what is the best book that you have recently read or are currently reading?
The best book I read in real estate, I'm going to do one better.
That'll work. Bring it to us. What we got?
You guys your clients, people want to get involved in how to syndicate deals. This guy's my mentor. His name is Gary Rappaport from Rappaport Real Estate in Manassas, Virginia. This guy is an icon. So here's the book. This guy will teach you everything in this book. I think it's about 400 pages. Yeah, it's 400 pages. He puts worksheets in, he puts graphs and pictures, everything in this book. Everything in here, how to raise capital, how to do a deal, and how he's done it. He has over $5 billion worth of real estate. And I would say about 8 weeks ago, it was kind of funny. I said, I bought a property. I paid, I think I paid like $12,750,000 for 2 shopping centers.
Yeah.
So I said, Gary, I closed on 2 more. At the same time, he just bought a shopping center for $130 million with a $40 million capital raise. And he'll tell you how to do it. So this is the best book I read, and I leave it on my desk as a reminder to stay focused.
Yeah, and I'll tell you, Gary knows the business. Gary has
yeah.
How long has he been in the business?
Gary's been in the business probably almost 40 years.
That's what I was thinking.
Yeah.
I'll tell you, there's those big capital raises, man. Those are the people like that. A lot of people talk about the hedge fund managers, and that's all we ever hear growing up is hedge funds, mutual funds, this fund, that fund. And people don't realize how close people like Gary are getting to those levels, but have real solid assets underneath them, like real deal, like nails and screws and sheetrock and 2x4s. And it's just unbelievable to me. So he's done very, very well for himself.
Yeah,
all right, next question. Yeah, and he's not done. Yeah.
No, he's not.
What is a dream vacation that you have either taken or hope to take?
Well, my wife just booked it now because we haven't traveled in a while. So we're going to do a little circle. So we're going to fly from Miami to Tel Aviv in Israel. Yeah. And check that out because I've never been there. I have so many friends going there. So we'll check that out. From Tel Aviv, we're going to fly over to Istanbul. Then we'll be in Turkey for a few days. And then from there, we're going to go down to Athens, Greece, and then over to Mykonos and Santorini, and then home. So that'll be my dream vacation because I've never been to any of those places. So that'll be a 2-week loop I do in August.
Whew, man, that's dream vacation for sure. I have a friend that lives in Istanbul, and he just is always wanting me to come visit. And they say, I have heard from many people, not just him, how beautiful it is there, and it's such a the culture is so thick, and that's as my listeners are very well aware. I'm a culture junkie. So anyway, all right, cool. Todd, listen, if the listeners heard something that resonated with them, or maybe they want to reach out to you or find out more about your company, what is the best way for them to do that?
Well, there's a couple of things if I could add in there. First, you could always send me an email at todd@cc-reg.com, reg.com. Certainly, you can look at our website, currentcapitalgroup.com. My Instagram is Life According to Todd. And what I also want to add in there is that because I've always wanted to give back, that's why I like to do a lot of these podcasts, that's why I have all these interns in my office, is I decided to write a book. So I have a book coming out this fall called Keeping It Real on Commercial Real Estate, where I answer all the questions and tell a lot of stories about my past in real estate from the beginning to the end. But to prove to the reader, because I read a lot of books, that my motive is not about me. My motive is to give back. 100% of the proceeds of the book are all going to charity. So that book will be out in the fall, and it's called Keeping It Real on Commercial Real Estate.
Man, that's awesome, and especially giving back to the community. Hopefully, we all forget that as good as this market's been, there's a lot of people that haven't quite had it as good as a lot of us.
That's right.
That's great. So, well, Todd, thank you so much for your time. I know you're a busy man, and I certainly do appreciate it. And listeners, if you like what you heard today, please head on down and tap that subscribe button. Again, tap it with your elbow, your eye, your ear, whatever you can do. Smash the subscribe button and leave us a 5-star review so that future listeners might know and understand a little bit about what we talk about here on the Cash Flow Pro. And Todd, again, I can't thank you enough. And listeners, I want to thank you for taking time out of your day to sit with us today and listen and learn. So, Todd, thanks again, sir. I hope everybody has a wonderful rest of the day.
Thank you very much. Have a great day.
Cash Flow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.